Welcome to our educational guide on stock market basics. Today, we're breaking down essential concepts for beginners, including stocks, exchange-traded funds, and dividends. Whether you're new to investing or just looking to brush up on your knowledge, this video will provide clear explanations to help you get started. Stay tuned to learn how to navigate the stock market with confidence. Let's dive in. 1. Introduction to the stock market. The stock market is a marketplace where securities, such as stocks and bonds, are bought and sold. It provides companies with access to capital in exchange for giving investors a slice of ownership in the company through shares. The stock market functions through various exchanges, such as the New York Stock Exchange and NASDAQ, where buyers and sellers transact stocks. Market prices are determined by supply and demand dynamics, influenced by company performance, economic conditions, and investor sentiment. For beginners, understanding these basics is crucial as they form the foundation of how stocks are traded and valued. 2. What are stocks? Stocks, also known as shares or equities, represent ownership in a company. When you purchase a stock, you acquire a portion of that company's assets and earnings. Stocks are typically categorized into common and preferred shares. Common stockholders usually have voting rights and may receive dividends, but their returns are not guaranteed. Preferred shareholders generally receive fixed dividends and have priority over common stockholders if the company is liquidated. The value of a stock can fluctuate based on various factors, including company performance and market conditions. Investing in stocks can offer significant returns, but it also involves risks, such as market fluctuations and company-specific challenges. 3. What are exchange-traded funds? Exchange-traded funds are investment funds that trade on stock exchanges, much like individual stocks. Exchange-traded funds hold a diversified portfolio of assets, such as stocks, bonds, or commodities, and are designed to track the performance of a specific index or sector. One of the main benefits of exchange-traded funds is diversification, which reduces the risk associated with investing in individual securities. By investing in an exchange-traded fund, you gain exposure to a wide range of assets, which helps spread risk. Exchange-traded funds are known for their liquidity and typically have lower expense ratios compared to mutual funds. 4. Understanding dividends. Dividends are payments made by a company to its shareholders, usually in the form of cash or additional shares. These payments represent a portion of the company's profits distributed to investors. Dividends are typically paid on a regular basis, such as quarterly or annually. Companies that pay dividends are often seen as financially stable and profitable, which can be attractive to income-focused investors. The dividend yield, calculated by dividing the annual dividend payment by the stock price, helps investors assess the income generated from their investments. 5. The role of market orders. Market orders are instructions to buy or sell a stock immediately at the current market price. They are one of the simplest and most common types of orders used by investors. Market orders are executed quickly, ensuring that the trade occurs at the prevailing price. However, they do not guarantee the exact price at which the trade will be executed, as market prices can fluctuate rapidly. This is particularly important during periods of high volatility or low liquidity. Understanding market orders and their execution can help investors manage their trades more effectively. In addition to market orders, other order types, such as limit orders, allow investors to specify a price at which they are willing to buy or sell a stock. 6. Stock market indices. Stock market indices are statistical measures that track the performance of a specific group of stocks, representing a segment of the stock market or the market as a whole. Common indices include the S&P 500, which tracks 500 large-cap U.S. companies, and the Dow Jones Industrial Average, which includes 30 prominent companies. Indices serve as benchmarks to gauge market trends and evaluate the performance of individual investments or portfolios. They provide a snapshot of market performance and are often used by investors to compare their investment returns against broader market trends. Understanding stock market indices helps investors interpret market movements and assess how their investments are performing relative to the overall market. 7. The concept of market capitalization. Market capitalization, or market cap, is a measure of a company's total value as determined by the stock market. It is calculated by multiplying the stock price by the number of outstanding shares. Market cap helps classify companies into categories such as large cap, mid cap, and small cap, which can impact investment decisions and risk tolerance. Large cap companies with a market cap over $10 billion are typically more stable and established. Small cap companies with a market cap under $2 billion may offer higher growth potential but come with greater risk. Understanding market capitalization allows investors to assess a company's size, stability, and growth prospects, aiding in portfolio diversification and risk management. 8. The importance of diversification. Diversification involves spreading investments across various asset classes, sectors, and geographic regions to reduce risk. By diversifying, investors aim to minimize the impact of poor performance from any single investment on their overall portfolio. This strategy helps balance risk and return by ensuring that a downturn in one investment does not disproportionately affect the entire portfolio. Diversification can be achieved through a mix of stocks, bonds, exchange-traded funds, and other assets. Additionally, diversifying within asset classes, such as holding stocks from different industries or regions, further mitigates risk. Understanding the importance of diversification can enhance portfolio stability and improve long-term investment returns. 9. Understanding stock splits. A stock split occurs when a company issues additional shares to its shareholders, increasing the total number of shares while reducing the stock price proportionally. For example, in a 2-for-1 stock split, shareholders receive 2 shares for every 1 share they previously owned, and the stock price is halved. Stock splits make shares more affordable and accessible to a wider range of investors. Although a stock split does not change the total value of a shareholder's investment, it can impact market perception and trading activity. Companies often conduct stock splits when their stock prices have risen significantly, aiming to attract new investors. 10. Key metrics and ratios. Key metrics and ratios are essential tools for evaluating stocks and assessing financial performance. Common metrics include the price-to-earnings ratio, which compares a company's stock price to its earnings per share, and the price-to-book ratio, which compares the stock price to the company's book value. The dividend yield ratio measures the annual dividend payment relative to the stock price, providing insights into income potential. Additionally, metrics like return on equity and earnings per share offer valuable information about profitability and financial health. By analyzing these key indicators, investors can make informed decisions about stock valuation, growth potential, and overall financial performance. Thanks for watching. If you found this guide helpful, please give us a thumbs up and subscribe for more insightful content. Don't forget to hit the notification bell so you stay updated on our latest videos. Share your questions or thoughts in the comments below, and we'll see you in the next video. Happy investing!